Welcome to the InterMarket Analysis video update. This is a weekly video where we look outside of the S&P 500 and we compare things to the S&P 500 to see if we can get any clues about what's happening with the S&P 500 itself. We look at other markets, we look at other indexes, we look at other sectors. I also do a pretty lengthy discussion of the current value of the S&P 500 based on the PE ratio or price to earnings ratio. We look historically, we look forward. I do a pretty extensive study as well between growth versus value. We want growth to outperform value when the market is positive. Not a lot of changes this week if you watch this video on a regular basis. We're not seeing anything switching from positive to negative, but we want to keep an eye on these things because quite often what will happen is these changes will be subtle and they'll happen over a period of time. And if you don't notice them while they're happening, they can catch you off guard. This is being prepared for Tuesday, February 18th. All right, little slip there. I'm used to doing this video for Mondays, but we have President's Day on Monday, so the market is going to be closed. Now, what I've done the last couple of weeks, because it helps me with my recording schedule, is every day in the daily video, I go to a site called isabelnet.com. They have a blog there. They have charts. Some of those charts are useful. They also update on Saturdays. I usually include the charts for Saturday in the weekly video update. Well, they don't update until much later on, and so it's easier for me to add these blog posts in the intermarket analysis video, and I can record the weekly video a little quicker, get that posted, get it ready for people to watch, and then a little while later I can do this video and add these to this particular video. What we're seeing right here are earnings going forward from here, whether they're from Morgan Stanley or consensus. The takeaway from this is that we're going up and to the right, and we've been doing that for a number of years. But if you watch this on a consistent basis, we're seeing these numbers coming down a bit. We're not seeing the explosive earnings growth that we had been seeing. It's still positive and it's still looking good going out into the future, but we want this to continue to go up. It'd be nice if it was to get a little stronger numbers than what we're seeing right now. If these start to go down looking into the future, the market's probably going to run into some problems. Okay, then what we have right now is a situation where the S&P gained 20% over the last year, oh, actually over the last 2 years, and then less than 3% in the most recent 3 months. So forward returns, specifically the next 3 to 6 month periods, tend to be less attractive. Okay, something to think about here. And this goes back historically. And when we had this kind of a scenario, and they're saying that this is similar to what we're seeing today, what has happened before. Doesn't mean we're going to turn and go down, but it just means, okay, we might be in for some less than what we're used to returns for a little while. It says while the average and median returns are similar, the win rates are lower with more downside risk. So just something to be aware of. Now, I do have a program, and one of the things that I really stress in that program is called hedging, where you don't need to lose money. If you set things up the right way, you implement hedging, and that replaces whatever was lost. And I focus on the SPY. And you can also use that generating income and so forth. But we watch for periods like this. When we're looking a little bit more negative, we make sure we're hedged, so we protect it. Everybody else is freaking out. We're just sitting back going, hey, what's going on here? Because we know the worst that can happen is that we will break even. All right, then. Looking at the median S&P 500 stocks trailing 6 month return explained by micro factors. Now, the very basic definition of this, as I remember it, is that macro factors, they apply to the whole U.S. economy. Micro factors are company by company, either by region, by city, and that's really what's influencing stock prices right now, inside the company and what's happening, 74%. And this goes back looking at 6 month return. So it is looking backwards to get this figure. All right, more stocks are outperforming the S&P. This is actually more positive. We like it when the mega caps and the Magnificent Seven stocks, when they really start screaming to the upside, that takes the index higher as well. It also helps the NASDAQ 100. But at some point, you got to say, okay, are the rest of the stocks going to come along for the ride? That would make things even more positive. And we're seeing an improvement here that the rest of the S&P 500 are doing better right now. Then, despite strong growth and beats this season, that's earnings beats, stocks are tending to get hammered right now when they come out with their earnings results, even if it's a stellar report with even good looking words about what's going to happen into the future. They're still getting hit kind of hard right now. So then we go in and look at valuation. This is historical. These are earnings reports that have already come out, and then we base that around the price, and we can see the price is way above this PE ratio of 20. 20 and above is considered to be expensive, but we've been seeing that for many years now. So it's nothing out of the ordinary, and people can complain about it, but then it just seems to stay that way. We don't use this for any kind of timing. We just want to be aware of this. Yeah, okay, the market's overvalued, but it keeps going up. Then this also looks at that same idea, but goes back to 1980 and different events that have happened and what the valuations were at that time. Now, Robert Shiller, who's kind of well known in the stock market, and he wrote a book called Irrational Exuberance way back in the early 2000s. That's based on an Alan Greenspan term when we were going through the whole dot-com boom and then ultimate bust after that. Well, he took a little variation of this and he's spreading it out over a period of time. You may hear this referred to as CAPE, CAPE 10, because he's using 10 years of earnings to come up with more of an average to get outliers and special situations out of the way. And we're coming in right now at 38.54. All right. Well, we can see we're pretty high with that when we go back and look at the historical chart. We're also way above that when we look at the median and the mean here. So, yeah, even when you look at this, the market is still considered to be expensive, but we've been seeing this now for quite some time. And this is also the same basic idea, but putting standard deviation bars around here. When you get too far away from this, then it has a tendency to come back. Well, we're well above the standard deviation here. This is +1. And then when we start going down, we hit the standard deviation of -1. And a lot of times that will be where we hit a bottom. This is very long term. I showed this chart a week ago. It doesn't change all that quickly here, but this is also suggesting that we are overvalued. Then stocks don't do that though. They don't look backwards on earnings that have already come out. They look forward to what are earnings going to be, and we calculate another PE ratio based on that. And on this chart put up by Edward Yardeni at yardeni.com, this also calculates a PE ratio. Well, the purple line here, this is the mega cap 8, and it's coming in at 29.5. We still use that 10, 15, 20 scale. So yeah, these are quite expensive right now. We also use that 10, 15, 20 scale for the S&P, and it's coming in at 22.2. So it's considered expensive, even looking forward. Now, more fairly priced, because we're right around the 15 level, are the mid caps and the small caps. Well, do they have the earnings to go up higher? They've been giving us a pretty fair reading for quite a while now. We've been watching the mid caps and small caps every day. They break out and then spend the next couple of weeks giving all that back. They're not doing all that well right now. And I'll show you later on in this video some different ratios, how small caps especially are underperforming when the anticipation was that they would be doing well. They're still just hovering around where the mid caps are at 16.1, the small caps are at 15.8. Then this is the PE 10. This is the Robert Shiller approach, and taking that out a bit further and comparing it to the rest of the world. Yeah, the US has the most expensive stock market, but it's also considered to be the best market with the best economy, with the most transparency, at least in the stock market. So it's like, okay, we're overvalued. Tell us something we don't know and that we actually care about. All right, now we look at growth all by itself. We want growth to do well, and this is a pure growth index where this is doing well all by itself. Then we look at a value index. Now, when value starts to outperform growth, that's when we start to get concerned. We saw that happening at the end of 2021, going into 2022, and that led to a cyclical bear market. We could see that coming. Well, so then we look for signs in these charts. Well, when you look at value all by itself, yeah, it's doing well. It's in an uptrend also. Where we get some insight is when we do ratios between the two. And this is showing that growth is outperforming value. value is underperforming growth. That's what we want in a more positive environment. Then I do a number of different studies of growth versus value. Here's indexes here showing how growth is outperforming. Another index look showing how value is underperforming. Then we look at some ETFs. Growth is outperforming value. Value is underperforming growth. You see the theme going on here? Another index look, shorter term. Growth is outperforming value. We look at a growth ETF versus a value ETF. Could be doing a little bit better than it is right now, but it's still positive and trying to come up out of the rainbow. Then we look at value versus growth, how value is underperforming growth. Then we look at the small caps. We break it out and just look at that. This is actually looking okay. It's gone sideways now for the last couple of months, but we are in an uptrend when we look at growth to value here. But you can see the index just kind of chopping around, not really doing all that much. Mid caps, kind of the same thing, looking pretty strong on a growth to value ratio basis. Not looking all that great here with the index. This is where we're looking better though. We're really near the all-time high with the S&P, and the growth to value ratio, even though it's been coming down over the last few sessions, it is still in an uptrend and showing how growth is outperforming value. That's what we want. That's when we are more positive. If we see a real breakdown in this, then that's going to get us more defensive. All right, we also keep an eye on inflation. This is a long-term chart, the monthly chart of the CRB index, which is commodities. And commodities are going up, and that's causing some inflation concerns. And we're above the moving average. Then we look at a ratio between inflation and deflation down below, monthly, long-term here. It is coming back up. We started about the latter part of 2024, but we're still below a declining moving average. Now, if we break above that and the red line starts to go up, and it's going to take a number of months for this to happen, then we're going to start to change our long-term inflation outlook. And when this is going down, that just means inflation is underperforming deflation. Okay, then here's a daily chart of the CRB index where it's in an uptrend right now and looking pretty solid there. Then we look at another inflation measure, the Baltic Dry Index, which this is actually in a downtrend. This is, somebody came up with this a number of years ago, so I built the chart and started following this. This measures some different things in the Baltics, the Baltic Sea. And when this is going up, usually prices are more expensive to ship products. When it goes down, prices are less expensive. And this has been in a downtrend decline for the last, well, couple of months here, really. Then another thing that we look at on a weekly basis, I also have a daily version of this chart, this is actually an ETF. It's inflation expectations. And this is going up as the CRB index is going up, and there are some concerns, and we're keeping an eye on inflationary things that could really spook the market, not just for a day or two, not where everybody's talking about it and freaking out about it, but what are the long-term trends? We hit the bottom after the COVID crash, and we've been going up ever since. That can also suggest good growth in the economy because inflation doesn't necessarily, until it gets to the point where it's too much, it can actually help the economy. It can actually help the stock market because prices are going up. Okay, then we keep an eye on some other markets. I'm not involved in any of these other markets, but I still like to keep an eye on them. We're just starting to see a downtrend here with aluminum. That's when the 50-period moving average crosses below the 200-period moving average. And we're still in a downtrend here, but we've really been popping back up with corn. This could be inflationary. Wheat still in a downtrend here, tried to pop back up, but came right back down. And I usually show a 3-month chart for this. I want to go back a year because fertilizer, this could also feed into inflation. And it's really starting to go up, and this could put some pressure on prices. Keep an eye on oil. Now, there's geopolitical things that could be happening over this holiday weekend as I record this, specifically in Israel. And sometimes when things get crazy geopolitically, oil really goes up. We've been hanging around down near the lower end of 70 lately. So we're not really breaking to the upside. We're not really breaking to the downside, but we are in a downtrend here. Then we look at a gold to oil ratio. Gold has been outperforming, so this ratio has been going up, but we've been chopping around here for the last few months. And then we look at the 10-year yield, which is black, and oil, which is dotted red here. And we do a correlation between the two. And you can see over time, they tend to move in the same general direction. Well, they kind of got decoupled in here back in November. And now they're starting to come more in line with each other. And so we're seeing that there's a slight tendency for these to go in the same direction at the same time. The higher reading we get here, the more correlated they are with each other. They're either going up or down together. When we get a real low reading down here around -1, that means we're going in opposite directions of each other. We keep an eye on gas, which is still in a downtrend, but has been bouncing up now that the election's over. Isn't that interesting? And heating oil starting to come close to setting a new uptrend here. In fact, we're just barely crossing above the moving average here. Natural gas, another thing that's now in an uptrend. And diesel, I just finished a fascinating book about Rudolf Diesel, who invented the diesel engine. If you like history, if you like mystery, if you like well-written books, I would highly recommend it. Contact me if you're interested in that. We have been going up here, but lately now we've been falling back with the price of diesel. Copper is still in a downtrend, but it's really going up now. We had CPI and PPI come out this past week that were much stronger than expected. And so that just shows the economy's looking pretty good. And when the economy's looking good, copper has a tendency to go up. When copper's going down, that generally means there's economic weakness. Now, it fell back a bit on Friday because the retail sales number ended up being a lot weaker than expected. Then we look at the copper to gold ratio. This has been declining now for quite some time. Copper's underperforming gold. And here's a longer term look at the copper to gold ratio going all the way back to 1980. And we see in other times where these three lines here, the 2-year yield, the 10-year yield, and the copper to gold ratio, they tend to move in the same basic direction. They're not doing that. We're seeing interest rates going up and the copper to gold ratio going down. So we've been watching this for quite a while now, last couple, 2, 3 years. And this is what we've been seeing here. I'm wondering if we're going into kind of a different shift in the economy, but we're not seeing it necessarily anywhere else. We're just seeing it right here. Gold just coming off of an all-time high on Thursday and then just got hit pretty hard on Friday. Silver also got hit on Friday in an uptrend, but not near an all-time high. We look at the closing price for gold on top, the closing price for silver in the middle, and we can see that the correlation's weakening a little bit because you'd think the correlation between these two would always be strong. And you're right, most of the time it is, but sometimes they get a little out of line with each other. And we look at a gold to silver ratio on top. When this is going up, gold is outperforming. When this is going down, silver is outperforming. And then we can compare that to the US dollar index. But over the last few weeks, we're getting more of a neutral reading. We're not really getting much conviction either way. The dollar is still in an uptrend, but it has been pulling back. If it continues to fall, that might help stocks like a weaker dollar. Okay, then the euro, and then on the bottom we have the US dollar index. And then on this next chart, here's the Japanese yen, the euro, and the US dollar, just to kind of eyeball all three of them together. Then I break them out, where the euro is still in a downtrend compared to the dollar, but it has been bouncing back. Japanese yen in a downtrend, also bouncing back lately as the dollar's been going down. The British pound also in a downtrend compared to the dollar, but recently bouncing back. Then we look at some index ratios here, and this is the weighted version of the S&P and then an equal weighted version. The red line's actually underperforming the weighted version of the S&P right now. When they're really on top of each other, that means the equal weight version is really doing better, and we see more broad participation in the S&P. We would like to see this improve more. And this kind of contradicts that Yahoo chart that we saw earlier, that more stocks in the S&P are outperforming. You can't really tell it by this chart. And then we look at a ratio between them. When this is going down, that means the equal weight is underperforming the S&P, and that's really what we've been seeing. This just means the really big stocks are still really controlling the indexes. Then we look at a stocks to commodities ratio, pulling back here, but still in an uptrend. Now we'll be watching this. If stocks can't really get something going here and turn this uptrend more positive, we could see a death cross here. And we're seeing an inverted version of this here, how commodities are underperforming stocks, but bouncing back. We'll be watching that. Now, some of you may ask, why do you have this chart and then an inverted version? Just to make sure we get confirmation, because these moving averages may not cross at exactly the same time. So when we see both the regular chart and the inverted chart crossing, we have more confirmation. We can put more confidence in that. Then we look at the NASDAQ 100, which has been coming on strong compared to the S&P. Even though both indexes are doing well, we've got the S&P near an all-time high, and the NASDAQ 100 is doing good, but it's been outperforming the S&P. These are the bigger stocks, the Magnificent Seven stocks, and we want them to do well. That helps the index to go higher. The S&P 100 was really starting to show some weakness compared to the S&P. The S&P 100 are the biggest stocks that are in the S&P 500. Now they're starting to bounce back, even though we've seen a recent death cross with this ratio. The Nasdaq is outperforming the S&P 500, and both are doing quite well by themselves. Here's again the Nasdaq 100 is now coming back, where last summer we saw the Nasdaq outperforming the Nasdaq 100. That's when this ratio is going down. Now we're seeing a real improvement with the Nasdaq 100 here, but not enough to generate a golden cross with this ratio. Small caps continue to underperform the S&P, and this has been going on now. We really fell apart at the early part of 2023, and we've just been going down with this ratio ever since. This is that same thing longer term. The red, that's the small cap to S&P ratio. The blue is the S&P itself. They're tending to go in opposite directions. Okay, then we look at the mega cap stocks, which are really driving the market, and we compare it to the equal weight index, and the mega caps are outperforming. They were seeing some weakness. Now they're starting to come back and show some more strength. Mega cap all by itself in an uptrend above the blue line, above the red line. Things are looking really solid here, coming really close, if not at an all-time high. Then the robotics and AI ETF. This is all the craze now. It's in an uptrend. It's above its rainbow. The only problem is when you compare it to the tech sector, we were starting to outperform, and now we've fallen back to the bottom end of the rainbow here. So it's not outperforming on a ratio basis. You'd be better off just getting into the tech sector. And the Dow Jones Composite Average, which looks at the Dow, the transports, and the utilities together, they're all going up, doing pretty good, even though the transports have just gone sideways. The utilities were strong, but now they're underperforming. A lot of this is coming from the Dow, and the Dow's not really doing all that much right now. And low volatility stocks. These are stocks that folks get into when they're concerned about the market going down. You can see it's not that they went up in 2022, it's that they didn't go down as much as other stocks. But now we're in a solid uptrend here. We came down to the 200-day moving average, and we're bouncing up above the 50-day moving average. But when we compare it to the S&P, these continue to underperform. Then, looking at the advanced decline line studies here, this improved a bit this past week. We're above the moving average with the NYSE common stock, S&P, and mid caps. We were under the moving average with the small caps, and now we're coming back up to the moving average. And this is what's called traditional Dow theory, which was developed by Charles Dow back in the 1800s. And he basically looks at the Dow and the transports, and are they confirming each other? Well, not really. We've got the transports underperforming. Now, I also include utilities, mainly because of the composite index. It also includes utilities, and they are underperforming as well. So this could be seen as a non-confirmation, a negative divergence here, because we've got the Dow doing pretty good, but the transports and the utilities not doing as good. That's a little bit of a concern, but that's longer term. Here's the transports, just kind of going sideways these days. This is a ratio between the Dow and the transports, where when this is going up, that means the Dow's outperforming. It pulled back a little bit with this ratio, but overall, the Dow has been outperforming. And then we look at another ratio between the transports and the S&P. Overall, this has been declining. We get little bits of hope in here, seeing that this starts to go up, but then it seems to top out and then go back down. Then looking at the correlation between the S&P and the transports, it's pretty strong right now. We're up into this red area. They're tending to go in the same direction at the same time. Now, instead of using Dow theory, traditional Dow theory, the idea was presented, why not use the S&P? Isn't that a better representation of the US stock market? That's 503 stocks instead of 30 stocks that are in the Dow. Okay, well, we'll go with that. And we're just close to the all-time high here. And then instead of using the transports, we don't, our whole economy is not based around railroads now. Well, it's based around technology, and that's what the NASDAQ is. And they're not necessarily hitting all-time highs yet, but they're not looking all that weak either. Then we break that down a little bit further. Let's take the equal weight version of the S&P which is not back to an all-time high and is actually drifting lower. And then let's look at an equal weight version of the QQQs, which is the NASDAQ 100. This is setting an all-time high. So right now, this would be considered a negative divergence, a non-confirmation. We're setting a high with the Qs. We're not setting that with the equal weight. We don't really freak out about this, but it's just something that we want to be aware of. The Wilshire 5000, a daily chart here, still looking solid. This is a broad market measure that we look at. And another broad market measure is the total US stock ETF, looking pretty good, getting near an all-time high. The FANG index, Facebook, Apple, Amazon, Netflix, Google, Nvidia, the big stocks, set an all-time high on Friday. So we're watching these trend lines here, and I drew these, and the computer didn't draw them. I kind of have to eyeball this, so just take it for what it's worth. We're looking at this short-term trend line, which has been providing overhead resistance at times. We're watching this longer-term trend line, which has been providing kind of loose support. And we're right in between the two now. Then we look at ARK. It's a real popular ETF. It's actually back into an uptrend now. And then we look at another ETF that looks at all world stocks, but it takes out stocks in the US. This is actually improving, and we're getting kind of close to this giving us a golden cross here. Then we do it using US stocks with a ratio with the rest of the stocks in the world, starting to underperform a little bit. We've been chopping around. We haven't been trending with the S&P for the last couple of weeks, and we're not really moving all that much. And so we're seeing this starting to underperform a bit, falling under the 50-day moving average. And then we look at a ratio between the small caps and the tech sector, underperforming, and has been now for quite some time. Then we look at another global look here. This is a monthly chart of US stocks to global stocks in Europe, Australia, Asia, and the Far East. Coming down a little bit, but still US stocks on longer term basis are outperforming. Then we look at an oscillator here. This is rolling over a bit. So we're going to be keeping an eye on this. This is longer term, and we're a little bit concerned about this. Then we look at the price of the 7 to 10-year bond ETF, which had been falling as interest rates have been going up. Well, interest rates have been going down, so the price of this has been going back up. This is the total bond ETF. And earlier on in 2025, I was really honing in on this. We came down to the 200-day moving average, actually dropped below it. Well, we were able to get back above it, and now we're above the 50-period moving average. And we're still in an uptrend here. And if we can keep going up with the total bond ETF based on price, that means interest rates are going down. The Pring World Bond Index is still in a downtrend. Stock to bond monthly chart showing stocks outperforming bonds longer term. This is a daily chart showing how bonds are underperforming stocks. High yield bonds, you also probably know them as junk bonds, just getting really close to an all-time high here. These are corporate bonds, a little more conservative, starting to improve a little bit. Let's see if we can save this uptrend that we're seeing right now. And then we look at a ratio between junk bonds and more conservative bonds like government bonds. Folks are still preferring the riskier bonds. They're willing to assume more risk to get a better yield. They're not seeing a lot of risk in those riskier bonds, and that could be more confidence in the economy. Then we look at a correlation between stocks and bonds, slight tendency for them to go in the same direction. The corporate bonds, still in an uptrend, falling back, fell under the 200-day moving average, coming back above the 200-day moving average and the 50. Can we save this uptrend? And then I have some Fibonacci retracement levels here, but we're far away from these lines with the 10-year. And we're going up into a higher area now with the 10-year yield. This goes all the way back to 1980. And then the same Fibonacci retracement levels here with the 30-year yield, but we're not close to either of these lines, any of these lines right now. This is junk bonds all by themselves, doing really well, and actually outperforming when we do a ratio between junk bonds and more conservative government bonds. This is a daily chart of yields where we had been coming down. That was helping stocks. Then we started to go back up. That was hurting stocks. Now we're starting to come back down. And this is a thing that we're keeping an eye on. The red line here is the 10-year yield in Japan. When it went above 1% last summer, that freaked everybody out. It's the day that the VIX went up to 65. Everybody was talking about it. It was the end of the world, lasted a couple of days. Well, interest rates are still going up in Japan. Is that going to become a problem at some point? And we look at a monthly chart here, the price of a 30-year bond based on price. where it's in a downtrend now, and it has been for quite some time. And then we look at a ratio between the long-term bond price and commodities. It showed that the long-term bond price was outperforming. Now we're starting to see that roll over. We're watching these things longer term. That could change the overall climate of the market. And we look at the S&P 500 and 1 to 3 year bonds. Stocks are clearly outperforming short-term bonds. Then we look at the S&P 1500. The broad market is outperforming short-term bonds. A broad market measure, looking at 3 to 7 year bonds, stocks are outperforming here. The tech sector is outperforming 3 to 7 year bonds. And then we do a ratio between the S&P 500 and the 10-year yield, getting kind of choppy right now. We're going to see the S&P had been outperforming, but it's getting a little bit weak. Then this is 3 to 7 year bonds with the S&P 500. This means that bonds are underperforming stocks. We look at the volatility of bonds measured by the MOVE index on top, and the volatility of stocks measured by the VIX, and we see that there's a kind of a high correlation. Now, this doesn't measure direction. This is just measuring the volatility of the top chart with the middle chart. Okay, then we look at different sectors. First, I look at the sector all by itself. This is materials, where they're in a downtrend right now, but they've been trying to bounce back up, and they're dealing with their 200-day moving average. But when you compare it to the S&P, continuing to underperform. Communication, a growth area, setting an all-time high here, looking pretty solid all by itself, also outperforming when we compare it to the S&P. Then we look at energy, which has been all over the place now, falling below. We've got a death cross here, chopping around between its 50 and 200-day moving averages. But when we compare it to the S&P, still underperforming. The financials, these are the banks, doing really good lately. So they're pretty solid right now and actually holding up quite well when compared to the S&P 500. Industrials, above their 50-day moving average, still in an uptrend and starting to underperform. We saw a recent death cross here with this ratio. So they're actually going down a little bit on a comparison basis. Technology, another big growth area, looking pretty solid all by itself. But when we compare it to the S&P, we're going sideways. Now, this isn't necessarily negative. Tech has been doing well. The S&P has been doing well. Both are near all-time highs. So this going sideways is not necessarily a bad thing. It just means they're confirming each other. Staples sector, this is more defensive. Fell down below its 200-day moving average, was able to get back above its 50-day moving average. But when we compare it to the S&P, underperforming. And that's positive for the market. If this was outperforming, that means the market's getting more defensive and probably getting ready to go down. Real estate really getting just blasted all over the place with interest rates going up and down and all over the place here. It's trying to make a comeback, getting back above its 50-day moving average, but in a downtrend when compared to the S&P. Utilities really strong for a lot of 2024, pulled back, almost got to their 200-day moving average, getting back above their 50-day moving average. But we've just seen a recent death cross when we compare it to the S&P and going sideways right now. And then I look at this, and I haven't been showing it because the chart has been so choppy. This is an S&P to utilities ratio. When this is going up, that means the S&P is outperforming. When this is going down, that means the S&P is underperforming utilities. Then we look at healthcare, which is more defensive, coming back, trying to get above its 200-day moving average, but seeing some weakness here and in a downtrend, and continuing to underperform when compared to the S&P. Discretionary, coming back up, trying to deal with its 50-day moving average, and it's outperforming here, but it has been seeing some weakness. And a lot of this has to do with weakness that's been coming out in Tesla lately. This is a huge part of the discretionary sector. Semiconductors, some charts have us looking positive, some negative. We're just chopping sideways right now. We're in a downtrend with the SOX index, but we're getting back above the 50-day moving average. If this could improve, that would really help the market do better. The energy sector to the tech sector shows energy underperforming. Growth is outperforming more conservative government bonds. And tech kind of chopping around now when compared to the 10-year yield, and chopping around here when we do an inverse of that same thing, the 10-year yield to the tech sector. Maybe something's going to happen here pretty soon. Discretionary is outperforming staples, even though discretionary has been getting hit pretty hard lately. And staples are underperforming discretionary. And this is positive. We want this to happen if we're more positive on the market. Gold has been doing really well. The S&P has been doing really well. So we're just kind of going sideways here with the ratio. And gold has been outperforming the dollar, especially as the dollar's been going down and gold has been going up. The NYC composite really near an all-time high and a solid uptrend here. High leverage loans, another proxy for the economy, still above its 50-day moving average and in really sustained uptrend here. All stocks, which look at US and international stocks, setting a new all-time high. Emerging markets, just barely trying to eke out a golden cross here. They are showing some improvement. And we got the Japanese Nikkei just hanging out around this level that was the high set back in 1989. It's just not moving. Just kind of blah, blah, blah. A lot of really messy stuff here. The micro caps, smaller stocks, they're in an uptrend as well. We look at a relationship between the S&P and the home builders ETF, which has been underperforming, but not all that drastic. When it gets really down to a low reading, that's when we really take note of this. Bitcoin, which cannot seem to stay very long above 100,000. It's underneath its 50-day moving average. And then this is going back to the beginning of 2025. Gold is performing the best, then stocks, then bonds, believe it or not, then oil, and then the dollar is actually negative on the year. Even though it was strong in 2024, it hasn't been very strong so far in 2025. This is the KST, a long-term momentum oscillator. Looking internationally, we're in an uptrend in China, emerging markets, Europe, Japan, but we're starting to roll over just a little bit here in the US. Then some correlations. We look at the S&P and the dollar. Strong tendency to go in opposite directions right now. S&P to oil, also slight tendency to go in opposite directions. S&P to the 10-year yield, almost neutral right now. Just not when it's in between 0.25 and minus 0.25, that's what I consider neutral. And then we look at the tech sector to the 10-year yield, also neutral right now. Then the S&P to the 2-year yield, still in neutral territory. And then some long-term charts here. This is a monthly chart of the NYSE, still looking really good. Rolling over a little bit with the Copic curve, another momentum oscillator. We'll see if that's going to continue to roll over or start to go back up. A daily chart of the NYSE, then looking at the record high percent index. It had been falling back. Now it's starting to go back up. The S&P long-term, a monthly chart here, still looking pretty solid, but we're rolling over a bit here with another momentum oscillator called the PPO. Then we look at the S&P on top and stocks to commodities, similar to what we saw before, and we're seeing this rolling over. And if this crosses below, that could suggest a shift in the overall climate. Then a monthly chart of the NYSE with the Copic curve here, rolling over just a little bit. And then another global look, US to global stocks. US stocks are outperforming, and the KST is still looking pretty strong there. Then at the very end, I list all those things that are positive. And this is when the 50-day moving average is above the 200-day moving average. And when you have the growth value indexes, the dollar's still in an uptrend. All these things are in uptrends right now. Gold, silver, mega caps, the FANG index, ARC, low volatility ETF when you look at it by itself, staples, the Dow Jones Composite Average, bonds based on price. The only one not in this list is emerging markets and the world bond. Pring World Bond Index. That could be turning over back positive. The tech sector, high leverage loans, the Dow, the NYSE Composite and Wilshire, the NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps, all stocks, emerging markets, and Bitcoin. Our list is still fairly short with those things that are negative. That's when the 50-period moving average drops below the 200. Copper, although that could be changing. The euro, the yen, the British pound. Now they've been bouncing back up, but they're still in downtrends compared to the dollar. The SOX index. But when you look at the ETFs, some of those are still looking pretty positive. And the world bond index is still negative. So thank you. I hope you found this helpful. Have a great weekend, and I will talk to you in the next video.